Technical analysis is the study of the past price movements of an individual share, a market sector, or the market as a whole to gain an insight into where the price might go. I will say here that this will be a bird's eye overview of some of the key concepts relating to technical analysis. Technical analysis is incredibly detailed and requires a good understanding of when to apply and deploy each indicator. But for now, we'll talk about what some of the key analysis techniques are. Charts convert a table of data into easy to interpret graphs. Take this example. Is it easier to tell the share's recent price history by looking at the table or the graph? The graph provides a quick snapshot of how the company's share price has traveled. To understand where technical analysis fits in, let's examine the objectives of both fundamental and technical analysis. Regardless of whether investors are aiming for income or capital growth, the main objective is clearly to make money from rising share prices. According to fundamental analysis, economists and market strategists make observations and forecasts about such things as new home sales, retail sales, unemployment, GDP, and inflation in an effort to determine whether or not the economy is growing or slowing. Technical analysts argue we can study all the economic factors and incorporate the theory from all of the experts and come up with a view on whether the share market is going up or down. Or we can simply look at the share prices themselves, which reflect the collective influence of all of the above factors. The argument in support of technical analysis is that all buying, selling, rumors, and statistics will be factored into the price of a share as people act on that information. By looking at the prices, we can see whether there is buying, which would result in the price rising. We know if bad news has come out or if it's expected to be released because sellers come into the market and push prices lower. Proponents of charting and technical analysis suggest that we can obtain all the information we need by observing the prices, and we don't need to look at anything else. We can look at a chart and draw some simple conclusions. Take a look at this chart here. We can see without knowing anything about the company and without even knowing the company's name that the share price peaked in February. There may have been a lot of good news coming out or just one factor. Technical analysts suggest that there are methods we can use to determine simply if the share price is an upward or downward movement. Therefore, we don't need to worry so much about what news is being released. Charts, according to technical analysts, reflect all the available information at any given time. If someone has information that no one else has and they act upon that information, they will affect the price and it will move to a new level. Forget the idea that charts can predict the future. They can't, and neither can fundamental analysis. We can, however, use some simple charting techniques that may assist in the development of a worthwhile strategy by giving us an insight into the underlying sentiment in the market. Before we look at developing some of our techniques, let's break technical analysis down into various subcategories. You may elect to develop your own combination of these techniques that are available and discover something unique. Classic technical analysis: indicators, cycles in price and time, trends, resistance and support lines, and chart patterns. That's what we'll be discussing today. Trends. Trends indicate the current direction of share prices. When stock prices continue to rise higher, it's considered to be in an upward trend and vice versa for a downward trend. Uptrends indicate increasing demand for shares as buyers are willing to pay prices higher and higher as supply diminishes. Downtrends represent an oversupply of shares, with waning buying interest resulting in falling prices. By connecting the various highs and lows on the chart, you can manually generate trend lines that pinpoint support and resistance and direction of stock prices. When compared to historical templates of similar trend lines, you may be able to forecast the future direction, turning and inflection points and targets. Defining a trend. This picture illustrates how easy it is to define an uptrend. Its simplicity is a little embarrassing, but only because so many of us are guilty of buying shares that are not only not in uptrends, but are actually in clearly definable downtrends. Notice that each subsequent high is higher than the previous high, while each subsequent low is also higher than the previous low. This is how an uptrend is defined. You must have higher highs and higher lows to have an uptrend. If you don't have both, you don't have an uptrend. However, you might not have a downtrend either. This picture shows a downtrend. The definition of a downtrend is lower lows and lower highs. If you look at this picture, you can see that each high is lower than the previous one, and each low is lower than the previous one as well. From a technical analyst perspective, you are doing yourself a disservice if you purchase shares that are in a downtrend. It's deemed prudent to wait until the uptrend emerges. Markets, however, are not as simple as these diagrams, and there are periods when the market is neither in an uptrend or a downtrend, and this picture shows that. In this picture, prices never reach a point where there is a succession of higher highs and higher lows. After the market registered the higher high, notice that the market then made a lower low. There is neither an uptrend nor a downtrend. The market is merely trading sideways with little indication of clear direction. This is known as range trading. There are tools available to enable you to trade in a sideways trending market, but I'm not getting into these today. For most investors, a sideways trending market represents a time to stand aside and do nothing. Establishing the direction of the market or share by determining whether it's in an uptrend or a downtrend or sideways can simplify the process of sorting through a myriad of shares and markets, enabling a search for the best opportunities. It should also save time, as determining the trend is objective and requires little interpretation. You should not have to spend hours poring over charts trying to determine where the market is going. Defining the trend should take less than 5 minutes and can be done at a glance. Resistance and support lines. While there are some limitations with classic technical analysis, they can provide some assistance in fine-tuning the timing of a change in trend. Let's look at using support and resistance levels to help define buying and selling points in the market. Resistance line. A resistance line is the level at which rising prices stop climbing and move sideways or downwards, indicating an abundance of supply. By drawing a line that connects all of the highs, we create what is called a resistance line. At this level, the market resists going higher because there are sellers who enter the market to sell more shares when the shares trade at this price. The weight of their cumulative selling prevents the price from rising. If the price were to break through the resistance, as it has here, it could suggest that sales at this price are complete, or that the sellers have decided not to sell any more of the shares for the time being. Either way, it could be supportive for the share and may even reflect the release of good news, which has resulted in sellers at the resistance price holding off or changing their minds. Technical analysts see a break of resistance as a buy signal. Support line. A support line is the level at which declining prices stop falling and move sideways or upwards because there is sufficient demand for the share to stop the price falling any further. By drawing a line that connects the lows of the range, we can show the level of support. The price is supported or stopped from going lower by the presence of a buyer or buyers at this price. Each time the price drops to the support level, buying emerges that is of sufficient volume to absorb the sellers and prevent the price from falling through. Suppose the price does break through the support level as shown here. What would that indicate? The first conclusion we can draw is that the buyers at the previous support price are no longer present, at the price at least. The buying has dried up and the selling is continuing now at lower prices. This selling at lower prices suggests that the sellers are becoming more aggressive. Volume. Volume is an important tool for technical analysts, and I could talk about volume for hours in all its various forms. What is most important for you to know at this stage is that rising volume at the time of a break of support or resistance is generally regarded as further confirmation that the break is legitimate and that the price is expected to continue moving in the same direction. This could be for a number of reasons. For example, the higher volumes may suggest more sophisticated and knowledgeable investors are establishing positions in the direction of the market's move. Or it could be simply because more individuals are discovering the particular factors that make an investment or trade in this share attractive. For technical analysts, finding reasons why this is the case is less important than what the chart is telling them, that the price is expected to continue to move in the same direction. Here you can see how volume can be used in conjunction with breaks of support or resistance. Chart patterns. A chart pattern is a shape within a price chart that helps to suggest what prices might do next based on what they have done in the past. Chart patterns are the basis of technical analysis and require a trader to know exactly what they're looking at, as well as what they're looking for. Firstly, we'll go over the ascending triangle. The ascending triangle is a bullish continuation chart pattern that signifies a breakout is likely where the triangle lines converge. To draw this pattern, you need to place a horizontal line, the resistance line, on the resistance point and draw an ascending line, the uptrend line, along the support points. This suggests that there is enough selling to absorb the buying at the same price. The support level, however, is sloping upwards. This suggests that the buyers are becoming progressively more aggressive and are increasingly willing to pay higher prices. The question you might ask is why? As noted before, technical analysts don't concern themselves with the answer. By looking at the chart, we can see that the buyers are more aggressive and so the price could go higher. If the price breaks through the resistance level, it looks like this. Buyers are more aggressive, paying higher prices, while the selling that was evident before dries up or ceases. According to technical analysts, prices could go higher. If you add rising volume to the picture, you have another validation of strength being exhibited in the market. A cautionary reminder is worth mentioning at this point: nothing works all the time. Next, we've got a descending triangle. Unlike ascending triangles, the descending triangle represents a bearish market downtrend. The support line is horizontal and the resistance line is descending, signifying the possibility of a downtrend breakout. Next, we've got a wedge pattern. A wedge pattern represents a tightening price movement between the support and resistance lines. This can be either a rising wedge or a falling wedge. Unlike the triangle, the wedge doesn't have the horizontal trend line and is characterized by either two upward trend lines or two downward trend lines. For a downward wedge, it is thought that the price will break through the resistance, and for an upward wedge, the price is supposed to break through the support. This means the wedge is a reversal pattern as the breakout is opposite to the general trend. Double bottom. A double bottom looks similar to the letter W and indicates when the price has made two unsuccessful attempts at breaking through the support level. It's a reversal chart pattern as it highlights a trend reversal. After unsuccessfully breaking through the support twice, the market price shifts towards an uptrend. The last one I'll talk about today is double top. Opposite to the double bottom, a double top looks like an M. The trend enters a reversal phase after failing to break through the resistance level twice. The trend then follows back to the support threshold and starts a downward trend, breaking through the support line. Adding a filter. There are many filters or indicators available to apply to shares, and many people get carried away. A filter or indicator is a proviso added to a set of conditions allowing or disallowing certain actions to be taken. Two common mistakes that are made at this step. The first is where investors try to get their hands on every indicator available and combine them all, believing if they are all given a buy signal, it must be going up. That's false. Using one indicator on a consistent basis may be just as effective as combining 2, 3, 4, or 100 indicators. Using 100 indicators is simply more work. The second common mistake stems from the fact that no indicator works all the time. As a result, some investors and traders spend many hours, days, weeks, and even years trying to develop the ultimate indicator that never gives a bad signal, or a signal that you never lose money with. Save yourself the time. No such indicator exists. Instead, choose one indicator that works for you. While choosing an appropriate indicator, use the following steps. Find something that you understand. Learn how to use it properly and start using it consistently. Remember that you will have losing trades. Just try to keep them small. Let your winning trades run. And lastly, expect to have more losing trades than winning trades. As already mentioned, if your winning trades are on average sufficiently bigger than your losing trades, over time you should be in front. Using indicators. Let's look at one of the simplest indicators around today, the moving average, and the ways it can be traded. Following this, we will add a trigger to see if we can bring our timing down to a specific day and improve the efficiency of the filter or indicator. The moving average is a common tool familiar to many investors and traders. The moving average is an average of the closing prices for the last N days. In the formula, N equals the number of periods. So a 30-day moving average is therefore an average of the last 30 days closing prices, rolled forward one day at a time. Similarly, a 3-day moving average is an average of the last 3 days, rolled forward one day at a time. This picture here may help to show you what I mean and how to calculate a moving average. All we're doing is adding up the total of the last N periods closing and then dividing by N. This gives us a series of numbers that we can plot as a line on a price chart. This image here helps to illustrate what a moving average looks like. The first step in trading with a moving average is to decide how many days, weeks, or months N equals. The larger the number, the smoother the moving average will be. You will also have fewer trades and fewer false signals. The downside is that you will give away a lot of the move before getting in and before getting out. With a shorter term moving average, you will get into a trend earlier and exit closer to the top, but you will also have many trades and many false signals and therefore more losing trades. Experiment to find out what works best for you by looking at, say, 15 days if you're a short-term trader or 30 weeks if you're a long-term investor. The common way to trade a moving average is to buy a share if its price breaks above its moving average and to sell it again when the price falls below the moving average. In this picture, you can see that the price broke above the moving average around $27 and then traded higher, not breaking below the moving average again until the far right of the chart at around $31 mark. Applying the moving average. Before you go racing off to plot the moving average on every share and buy everything that rises above it, a few points are worth remembering. Nothing works all the time. As shown here, the moving average is an indicator that can keep you in an uptrend for a long time. It is also good as a signal to get out of the market during a downtrend as the price moves below the moving average, also shown here. Once the price moves below the moving average, there is a risk that a downtrend could transpire. Because of this risk, the trader may stand aside. If the downtrend continues, stepping aside will have prevented further losses. In a non-trending market, however, the moving average will always see you lose money when traded in a classic fashion. In the sideways market, such as what we've got here, the moving average travels through the middle of the prices and forces the trader to buy high and sell low every time. This is a surefire way to lose money, so a moving average should only be applied to a trending market. Combining tools. In the last section, we discussed analyzing companies using fundamental techniques such as ratio analysis. Suppose you came across two companies in a sector of the economy that was enjoying some growth. Now suppose you look at the economic environment and with low interest rates, inflation subdued, and an expanding money supply, you decided that the environment was ripe to make an investment in the share market. Both growth companies display the following characteristics: low debt to equity, high dividend yield, strong return on equity, and strong historical dividend growth. Now let's assume that the price for each share is exactly the same. The only difference between the two is that company A's shares are above the moving average and company B's shares are below a declining moving average. What would you do? In this situation, all of the available fundamental information has been combined to find two companies that represent an opportunity. By adding technical analysis, you may discover that the market's consensus view, as reflected in the chart of each company's share price, for company A appears better than that for company B. Perhaps there is some information known in the market about company A that has not been discovered. Alternatively, perhaps there is no other available information and the share price chart is illustrating the better market sentiment surrounding company A's shares. We may speculate about what is going on, but the combination of fundamental analysis and technical analysis has provided us with a more complete picture than available with just fundamental analysis. So finishing up, this has obviously been a very quick overview of all these concepts. I tried to keep this as low level as possible, but to cover as much as possible for that eagle eye view. If you've made it this far, thank you so much. I hope this has been a good starting point, and please like and subscribe so we can continue to build our knowledge together and continue taking steps towards financial freedom.